There is no perfect way to predict recessions or the rest of the economy, but if you're looking for one indicator that does a fairly good job, the yield curve is the way to look. I'm Dr. Bill Connerly. I connect the dots between the economy and business. There's been growing fear of recession as I record this in May of 2022. And we had a brief period where one measure of the yield curve suggested that maybe there was a recession coming. So let's go into more detail on what this yield curve actually means. The yield curve represents interest rates of different maturities. Let me give you an example here. The interest rate you would earn if you buy a bond or a treasury bill depends on the maturity of it. And in general, this is an upward sloping curve. At the bottom left of this chart, you see the 1 month interest rate, the 3-month interest rate, the 6-month interest rate. And at the upper right, you see the interest rate on 10-year bonds, 20-year bonds, 30-year bonds. And this is the normal shape. There are some wiggles here and there that we pretty much ignore. When this is the shape of the yield curve, we kind of shrug our shoulders. But occasionally the yield curve is inverted. That is, it is downward sloping. Short-term maturities pay higher interest than long-term maturities. And this is the yield curve that we worry about. The way to look at this is not just to look at a yield curve at one point in time, but to get an understanding for how it changes over the course of the economy. We do this by taking a particular yield curve and we figure out what's the 10-year rate, what's the 3-month rate, and what's the spread between them. In this video, I'm going to talk about the difference between the 10-year rate, the 3-month rate. You can do any pair of different maturities. You can do exotic things with some expectations. A number of people like the difference between the 10-year and the 2-year, but we're going to stick with the 10-year and the 3-month. We do that calculation not just for April, but for every month that we have data for, and we end up with something that looks like this. When the line is above 0, that means that we have a normal shape with long-term interest rates paying more than short-term interest rates. But you'll see that there are some episodes where the line is less than 0. That means short-term interest rates are higher. That is what we are worried about. This is hard to look at, so let's superimpose recessions on there. There's a nonprofit group, National Bureau of Economic Research, that figures out when each recession began and when it ended. The period of recession is shaded here in gray, and this helps, but I think you'll get a better idea if we focus in. Let's look at what happened before the 2008 recession. This area in the circle I'm going to zoom in on, and you can see that in the early months on the left of this chart, we had positive numbers. That means the 10-year bond was paying more than the 3-month bill. But then something happened. The yield curve inverted, and for a period of months, 16 months, it went negative until we got into the recession, which here I've colored pink to help you see this is a recession, this is a problem. But notice what happened in the middle of the recession when people were doom and gloom. The yield curve flipped around to a normal shape. This is the yield curve's way of saying to us, don't worry, things are going to get better. As we move forward, it's worthwhile keeping in mind that we've just looked at an episode that was particularly good, but things are not always that clear-cut looking at yield curves. For example, this is the same picture you've seen before, but let's focus on those first 3 recessions, the recessions of 1953, 57, 1960. There was no signal ahead of time. The yield curve failed to tell us that a recession was coming. Let's also look at a period in, I think this is 1966, where the yield curve flipped and flashed a sign that a recession was coming, but we did not have a recession for about 4 years. That was too early to be useful to people. So the yield curve is not at all a perfect measure. How good does the yield curve do? How much notice does it give us? The example we showed of 2008 was a 16-month advance warning. The shortest advance warning we've seen in the record is a 6-month advance warning. So when the yield curve flips to negative, it doesn't always mean a recession. If it does mean a recession, it's coming in 6 months to 16 months. That's a long time period. So this is not a high precision instrument. It is a rough indicator. It tells you maybe we ought to be worried a little bit. The next point I want to make is that the yield curve itself is not a cause of recession. It's an indicator, but not a cause. The typical process is that before a recession, the Federal Reserve gets nervous about inflation, and bondholders have also gotten nervous about inflation. Long-term interest rates have risen because of that nervousness about inflation, and then the Fed tightens, and they do that at the short end, that is 3-month, 6-month interest rates go up. But as the 3-month interest rate is going up, bond investors see that the Fed is taking action, and they start becoming more comfortable about inflation not being too high. So long-term interest rates go down on expectations of lower inflation, while short-term interest rates are going up, and that's the inversion of the yield curve. So it's an indicator, but not a cause. So if you're running a business, how do you use this? My suggestion is keep an eye on that spread between the 10-year and the 3-month interest rate. There's a link in my Forbes article on this subject that you can get the data directly from the Federal Reserve. Look at it, but don't take it as a precise forecast for what's going to happen. Now, those of you who are thinking about your stock market investments, I've got bad news for you. The stock market tends to turn down before a recession, just as the yield curve inverts before a recession. And sometimes the yield curve turns first, sometimes the stock market goes down first. So the yield curve is not a reliable way to time the stock market. That's one of the many reasons we economists generally recommend you not try to time the stock market. But if you are inclined to try it, you might look at the yield curve, but I would not expect too much there. I'm Dr. Bill Connerly. I connect the dots between the economy and business. I put out a monthly newsletter that I'd be happy to share with you. It's a 60-second update on the economy once a month. Thanks for watching.